Welcome to our deep dive into the world of asset allocation, a crucial strategy for managing a substantial $100 million portfolio. Understanding how to effectively distribute your investments across various asset classes is not just a skill but a necessity for preserving and increasing wealth. Today, we'll explore diversified investment strategies tailored to suit various risk tolerances and investment horizons. Whether you're a seasoned investor or a newcomer to the financial arena, mastering the art of asset allocation is essential for achieving long-term financial goals. Stay tuned as we break down the complexities of balancing a large portfolio across stocks, bonds, real estate, commodities, and alternative investments, ensuring you're well-equipped to make informed decisions about your financial future. Understanding asset allocation. Asset allocation is the strategic distribution of investments across various asset classes, and it plays a pivotal role in shaping investment performance. By diversifying your portfolio, you not only manage risk but also enhance the potential for achieving your long-term financial objectives. This strategy involves spreading investments across different categories such as stocks, bonds, real estate, commodities, and alternative investments. Each class carries its own level of risk and return, influencing how your portfolio performs under different economic conditions. For instance, while stocks may offer high returns during economic booms, bonds provide stability during downturns. Understanding these dynamics is crucial for any investor, particularly when managing a substantial portfolio. Effective asset allocation helps safeguard your assets while positioning you for both conservative growth and significant gains over time. Stocks. In the realm of asset allocation, stocks play a vital role, especially in a $100 million portfolio. Allocating a portion of your investment to domestic stocks provides exposure to the U.S. economy through large cap, mid cap, and small cap equities. Each category offers different levels of risk and growth potential, with large caps generally being the most stable and small caps presenting more growth opportunities, albeit with higher volatility. Expanding into international stocks introduces geographical diversification. This segment includes both developed markets, which are typically more stable but offer lower growth rates, and emerging markets, which are riskier but can yield high returns. Such diversification is crucial as it reduces risk by not being overly reliant on any single economy and taps into growth opportunities worldwide. Bonds. Investing in bonds is a key strategy for adding stability and predictable income to a $100 million portfolio. Government bonds, such as U.S. Treasury securities, are cornerstone assets that provide safety and low-risk returns, making them an essential part of conservative investment strategies. On the other hand, corporate bonds offer a spectrum from investment-grade to high-yield options. Investment-grade bonds are safer but offer low returns, whereas high-yield bonds, though riskier, can potentially deliver high returns. This allows investors to balance risk and reward according to their comfort levels and financial goals. Lastly, considering global bonds can be advantageous. These bonds allow investors to benefit from interest rate differentials across countries and diversify currency exposure, further spreading risk and enhancing the potential for returns in different economic climates. Real estate. Real estate investment is a crucial component of a diversified $100 million portfolio. One can engage in direct investment, purchasing commercial, residential, or industrial properties. This approach offers substantial control over investments and the potential for significant capital appreciation and rental income. Alternatively, investing in real estate investment trusts, REITs, provides a more liquid option to access the real estate market. REITs invest in various property types and offer investors a share of the income produced through real estate without requiring direct management of the properties. This can be particularly attractive as it combines the benefits of real estate investment with the flexibility and liquidity not typically associated with direct property ownership. Both strategies provide unique advantages and can be tailored to meet specific risk tolerance levels and investment objectives, making real estate a versatile component in asset allocation. Alternative investments. Alternative investments offer unique opportunities to diversify and enhance the potential returns of a $100 million portfolio. Hedge funds are a prominent option within this category, employing a variety of strategies like long-short positions, arbitrage, and derivatives trading to achieve high returns. These funds aim to generate alpha, providing non-correlated returns to traditional stock and bond investments. Private equity is another significant alternative investment, focusing on capital investment in private companies that are not publicly traded. This asset class can drive substantial growth by transforming these businesses before a potential sale or public offering. Including commodities such as gold, oil, and agricultural products can also be beneficial. Commodities help hedge against inflation and market volatility, providing a safeguard during economic downturns while contributing to portfolio diversification. Each of these alternative assets introduces different risks and rewards, making them vital for sophisticated investors seeking to optimize their investment strategy. In conclusion, diversifying a $100 million portfolio requires a sophisticated approach to asset allocation across a variety of asset classes, including stocks, bonds, real estate, and alternative investments. Each class plays a crucial role in balancing risk and enhancing potential returns. It's important to remember that the right mix depends heavily on individual risk tolerance, investment horizon, and financial goals. A well-thought-out asset allocation strategy is essential for effectively managing large portfolios, reducing volatility, and achieving long-term objectives. We encourage all investors to consult with financial professionals to develop an investment strategy that is tailored to their specific needs and circumstances. This personalized approach will help in navigating the complexities of investing large sums and ensure that your financial legacy is secure and prosperous.